The $50,000 illusion. How your bank really makes money and why it changes everything. You walk into a store, you hand over $1 for a product. Before you even leave, the seller turns around and sells that exact same product to someone else for $7 right in front of you. You'd call that absurd, maybe even a scam. And yet, this exact mechanism quietly powers one of the largest industries on earth, retail banking. The difference is simple. In banking, the product is your money. Chapter 1. The quiet trade you never see. Right now, as you read this, your bank is doing something with your savings. You might think your money is just sitting there, safely stored, waiting for you to use it. But in reality, it's working just not for you. Banks take your deposits, bundle them together, and lend them out to others at significantly higher interest rates. While you might earn around 0.5% per year on a traditional savings account, the same money could be earning the bank anywhere from 6% to 25%, depending on where it's deployed. Mortgages, personal loans, auto loans, credit cards, each one is another layer of profit built on top of your idle cash. The gap between what they pay you and what they earn is called the net interest margin. And it's not small. In fact, that gap is the foundation of their entire business model. Chapter 2. Why most people never notice. You might wonder, if the difference is so large, why don't more people react? The answer lies in human psychology. When your savings are relatively small, say $5,000 or $10,000, the difference between earning 0.5% and 4% doesn't feel life-changing. It might amount to a couple $100 a year. For most people, that's not enough to justify the effort of researching alternatives, opening new accounts, or moving money around. Banks know this. They rely on it. In fact, studies have shown that a majority of people never compare their interest rates with other institutions, not once, not even out of curiosity. This inertia is not a flaw in the system, it is the system. Chapter 3. The $50,000 threshold. Something interesting happens when your savings reach around $50,000. The math changes. At that level, the difference between earning 0.5% and 4% is no longer a minor inconvenience, it becomes real money. Around $1,750 to $2,000 per year. That's a vacation, a few months of rent. A meaningful financial difference. More importantly, it becomes visible. You start asking questions. Why isn't my money growing? Where could I get better returns? What alternatives exist? This is the moment when you shift from passive customer to potential risk. And your bank knows it. Chapter 4. The hotel analogy. Imagine staying in a mid-range hotel in a busy city. The room is fine, not amazing, not terrible. But there are small annoyances. The water bottle costs $12. There's an unexpected service fee. Parking isn't included. The bill always seems slightly higher than expected. You tolerate it because switching hotels feels like effort. Now imagine you discover another hotel just down the street, 30% cheaper. Free parking, no hidden fees. Suddenly, staying doesn't feel so comfortable anymore. That's exactly what happens when your savings reach a certain level. Your bank becomes that first hotel, and alternatives become visible. Chapter 5. You become predictable data. Banks don't guess your behavior, they model it. They track patterns, balances, habits, and timing. They know when you're likely to spend, when you're likely to borrow, when you're likely to leave. Crossing a certain savings threshold triggers internal alerts. Not because they care about your success, but because you're now statistically more likely to move funds elsewhere, open investment accounts, reduce borrowing, become less profitable. In other words, you're no longer an ideal customer. Chapter 6. The business model isn't personal. It's tempting to think banks are greedy. But that's not quite accurate. They're rational. They charge what customers are willing to accept. And as long as most people don't question the system, there's no incentive to change it. The real issue isn't greed, it's inertia. For years, you may have been the perfect client. Small balance, minimal movement, occasional borrowing, no rate comparisons. From the bank's perspective, that's optimal. But once your financial awareness increases, the relationship shifts. Chapter 7. The cost of complacency. Let's look at a simple example. You have $50,000 in a savings account earning 0.5%. That's $250 per year. Now imagine moving it to an account earning 4%. That's $1,000 per year. The difference, $1,750 annually. Over 10 years, without even considering compounding, that's $17,500. Chapter 8. The Hidden Power of Liquidity. Savings do more than generate interest, they change your behavior. When you don't have liquidity, you rely on credit, emergency expense, use a credit card, broken appliance, financing plan, medical bill, payment plan with interest. Each of these situations benefits the bank, but when you have sufficient savings, something shifts. You gain time, and time removes urgency. Without urgency, you don't overpay. You don't rush decisions, you don't accept bad terms. This is where real financial power begins, not in earning more, but in needing less from the system. Chapter 9. The Attention Tax. There's a concept often overlooked in finance, the attention tax. When you're financially stretched, your mental energy is consumed by immediate problems, paying bills, covering shortfalls, managing stress. This leaves little room for long-term thinking. But once you build a financial buffer, that mental pressure decreases. You can compare options, plan ahead, make rational decisions. This shift alone can have a larger impact than any single investment strategy. Chapter 10. The alternatives you are ignoring. Once your savings reach a meaningful level, new options become worth considering. High-yield savings accounts, money market funds, short-term government securities, low-cost index funds. These aren't exclusive tools. They've always been available. But below a certain balance, the effort outweighs the benefit. Above it, the equation flips. Chapter 11. When the bank starts calling. As your behavior changes, so does the bank's response. You may notice offers for premium accounts, invitations to speak with advisors, credit line approvals, promotional interest rates. This isn't coincidence, it's strategy. They're trying to bring you back into a profitable position, often through fees, managed products, new forms of debt. Not all offers are bad, but none are neutral. Chapter 12. The Fee Trap. One of the most overlooked costs in finance is fees. A 1% annual fee might seem small, but over time, it compounds just like returns. For example, $50,000 growing at 6% annually, with a 1% fee. Over 20 years, that fee can cost tens of thousands of dollars in lost growth. Not because the fee itself is large, but because it reduces your compounding base. The earlier it's removed, the larger the impact. Chapter 13. The Three-Layer System. To reduce dependence on traditional banking structures, a simple system can be used. Layer 1. Operational cash, 2 to 3 months of expenses, immediate access, used for daily life. Layer 2. Yield layer, high-interest accounts or low-risk instruments, protects against inflation. Generate steady return. Layer 3. Growth layer, long-term investments. Focus on minimizing fees. Designed for compounding, the key is separation. Each layer serves a purpose, and none rely entirely on the bank. Chapter 14. Automation beats discipline. Most people understand what they should do. The problem is consistency. Banks rely on this. They know you won't manually move money every month. The solution is automation, automatic transfers, scheduled allocations, defined thresholds. Once set, the system works without constant attention. And that removes the biggest barrier, human behavior. Chapter 15. The Real Turning Point. Financial independence doesn't begin when you earn more. It begins when your system stops leaking value. At around $50,000 in savings, that leakage becomes visible. You start to see lost interest, hidden costs, structural inefficiencies. And once you see them, you can't ignore them. Chapter 16. To futures. Imagine two people with identical incomes. One leaves everything as is, low interest savings, occasional fees, no adjustments. The other optimizes rates, reduces fees, automates decisions. After 10 years, the difference might be tens of thousands. After 20 years, it could reach 6 figures. Not because one worked harder, but because one stopped subsidizing the system. Chapter 17. The Final Realization. Your bank is not your enemy, but it's not your partner either. It's a service provider optimized for profit. Once you understand that, your role changes. You stop being passive, reactive, dependent, and become strategic, intentional, independent. Chapter 18. What happens next? The moment you recognize how the system works, you face a choice. Do nothing and remain comfortable, or act and take control. It doesn't require drastic changes, just small, deliberate steps. Review your accounts. Compare rates, identify fees, move excess capital. Each step compounds. Just like everything else. Closing thought. The system isn't broken, it's working exactly as designed. The question is simple. Are you part of the mechanism or are you managing it?